to another class. Welcome back to another class on synthetics. I told you guys, I introduced stacking at specific points. By the way, for that person on the was it question group that day that was talking about when you come after saving your layout and you come back, it's not there. See, here's what happens when you come back to your deriv interface. You see this place, this arrow, just after save, upper right. This is your right. This arrow that I'm pressing that is saying save layout and load layout. So what you load layout that you have saved before automatically like changes to what is supposed to be, just like understand, so that you don't keep asking what I've said. All right. So yeah, and welcome back. Remember the intro specific. I talked about stacking as just maximizing to do what to maximizing opportunities to make profits, in the sense that you're opening multiple positions, one position. And I already told you guys that when you have a trade analysis, wherever or whatever time frame it may be, something just like this, you have a buy position running, or maybe and you're looking to take a buy from this zone. I told you that the first thing you're going to do after making your analysis is to pick up your Fibonacci 2 or your Gantt towards 50, and then map out from your stop loss towards your take profit targets. And anything you're going to be doing in this case is going to be what in the first 50%. Every stacking that will be done at this level will be done what in this 50% from this 0.5 to this point, right? Once price breaks above this level, you're no longer what stacking. Explain that the main reason why you're doing this is because of the fact that these prices can do what they can actually when price starts getting into buying, you can have supply zones do what send price back down. And if you've stacked or overstacked, or you've overstacked, there are chances that it takes you out. So you want to make sure that whatever you're doing is what still discount. Guys, every trader is to buy when market is buying and is to sell what when the market is selling. But at the same time, the goal of every is to what buy at cheaper prices and do what sell at what higher prices. Even in real life, you see people want to maximize what their gains. They want to buy things when it's not cheaper. Something that is in high demand, they sell at what higher prices. Everybody wants to get things cheaper and buy what's higher. So it's the same thing. You want to buy at what in count zones, what at higher prices. That's how you make money. Buying cheaper and do out and selling higher. So even when you have a sell setup, what you to be what between this point and what this point, that's what your premium for your sell setups, and then for the buy setups is going to be what between this level and what this one. So it's just like you're stacking at discounts and you're stacking at what premium. All right, when you're buying and when you're selling. And I also told you guys that these stacking levels, they are usually on the engulfing candlestick, and which I showed some examples of these engulfing candlesticks and how they can be. I told you that there are pairs some pairs can give you up to, there are times where you can have setups where you have like up to 5 stacking points on them. There are pairs you have like 3. They are the ones that present you with only that can give you just 2. The stacking levels are different. So at these different points, you have to understand that your first stacking level is what your entry, which I told you that entry you should actually be opening up to 40 to 50% of your overall risk, and then every other setup should be every other stacking point inside I mean every other percent, that's from the remaining 60 to 50%, maybe 50 to 60%, should be spread among the other peak points. So we engulfing points in last class where I showed you guys how these engulfing candlesticks can be. But then with how these points are going to be stacked on, we recognize where the engulfings are and all of that, but then how do we stack on this particular engulfings? All right, so that's all today's class. Now, there's something I want you to pay attention to. Okay, this is an engulfing candlestick. Something like this is an engulfing candlestick. All right, let me paint this. Okay, before the painting, something like this as well is an engulfing candlestick. This is an engulfing. Let's say this is a red. And then here we have what? Another green. Bullish engulfing candlestick. Now this is engulfing one, and this is what? Engulfing two. But you would agree with me that these six, they kind of engulfed differently. All right. Now, if you look at the first one, the difference between the bullish and the bearish candle is not so. But if you're going to be comparing it with the second one, the difference between the first and the second candlestick and the second bullish engulfing candlesticks is what? Very significant. This one is what? Way bigger than this one. So if I tell you that, oh, you should stack as engulfings, it is very normal that what now comes to your mind is this. Oh, is it that when price now closes, I will now start stacking at this level? All right, so my stop loss now be? Because stacking at the close of this one is very different from stacking at the close of this one. All right, here you have what? An entire stack at the what? Close of the engulfing candlestick. You're going to have something like this. All right, but then in this case, it's very different from what having something like this. I don't know if you understand what I'm saying. So what I'm trying to point out in ways that engulfings can be formed, but then they cannot be traded in the same way, because this engulfing now, if you're doing stack at the close of this engulfing, this is going to be very risky because it was a far the smaller, that's a bearish candlestick, and this one is what? This particular one, you can see that price was closed almost at the same level. Let me show you what I'm trying to say. This is an engulfing on the chart here now. This is a bullish engulfing candlestick. This one here and this one here. This is what? Bullish engulfing. Now you can see that the difference between candlestick bearish and candlestick bullish so much, but it's very different from what happened here. This particular bearish candlestick and this particular what? Bullish candlestick. You can see that it's different. All right, and then you can see here now we had this of this bit. It's very different from what happened. Let me look for something. A minute. It's very different from what happened. Let's say here now. Here we have this bullish candlestick and this bearish candlestick. All right. So what I'm trying to say is that what price can engulf big way and then and in like something just and start at in this same manner, right? So let's look at the setup. This is VIX 100S on the 30 minutes time frame, by the way. Now I told you that most of my setups are usually gotten on the 1 hour time. Sometimes if like too clumpy, what I do is to expand to the 2 hours time frame. But if I feel like the 1 hour time frame is not giving enough details like I want, what I reduce to the 30 minutes time frame. So it's just like more like from 30 minutes to 4 hours. All right, those are the time frames that I usually work with. Although I told you that you can even get some of your POIs on the 15 minutes that you cannot be that. I just the higher time frame narrative and structure. That way you're always like most likely in line with what price is doing, and at the same time helps you cut a lot of losses. All right, so let's look at this is our typical type B setup. All right, your price did what swept liquidity, came back, had the sweep, but before the sweep created what a form of inducement. This is the level, and then after that it broke through. All right, although I won't call this another break of structure, that's why I didn't say type A. Okay, so this is like a type B market structure, and then price mitigated the entry just like this. So now here is a confirmation on this particular setup. The confirmation is more like what a type A entry model. Our type A entry model closely, we had what our sweep of structure, and then we had what price break this low. Now after breaking that low, it pulled back to create what to create this particular high, and then what broke again. Our sweep, then this one here, which is what our type A entry model for what for pattern confirmation. Now price as you're done making that analysis, what's out your gambles to from wherever your stop loss may be towards your take profit target. Even if your stop loss is what at this level, even if your stop loss is at this level or any level at all that you have placed, what you're going to be mapping out from that level towards from the take profit target on that level towards to the stop loss on that level. Wherever I just like to give my trades a little bit of space. All right, but then let's look at now you have price, mitigate your entry. I told you that when you have your setups already, you're not going to be playing with limits. You're going to use what you're going to be using um price, which is after you've seen a confirmation on your entry. And that confirmation is going to be what? Whether pattern confirmation or candlestick confirmation. When it comes to candlestick confirmation, we already candlestick confirmations, which is what the hammer, the pin bar, the bullish and the bearish engulfing candlesticks, and then the doji candlesticks, which are what the reversal candlesticks. Now, if you look at what happened here now, after this type, it set to the entry and gave us what a pin bar, which is what this rejection candlestick. Now, at the question of this pin bar, you already understand that okay, well, price is now what price is now bearish. This is my confirmation to enter. All right. Now, when price has created this pin bar, what is the next thing you're looking out for? You're looking for out for what? For engulfing candlesticks in the first 50% of price level. Now, you agree with me that this is what? This is the first 50% of price level. Looking out for engulfing candlesticks, what? In this premium leg. All right. So, which in this case, now you have what? You have price creates what? We had now your entry after you have gotten your is what your entry is your first stacking point. Entry first stacking level. All right, your entry is your first stacking level. So what you do with this is where you open your first series of trade. Now let me tell you something. The number of trades that people open when they are stacking, there's no rule of this is what you do, this is what you do. Open it according to the lot sizes. For something like VIX 100, the minimum lot size on VIX 100 is 0.5. So if I'm stacking and I want to stack like a total of $40 for, and let me say I want to stack a total of $200 now for my account balance. Let's say in a 1K account, and at entry level, I want to stack $200 at that level. $200 worth of positions at that level. Now, opening 0.5, which is the minimum lot size on VIX 10, let's say opening 0.5 like 9, 10 times now may help me achieve that amount that I want to, right? But then if I decide to open 5 lot sizes, right? It will still be what the same thing. So if I decide to go to my MT5 and just put what lot size 5, I'm still going to what achieve the same thing as the person that did what 0.5 10 times. All right. So people actually sizes, the number of positions is your choice. If you want your positions to be too many, or if you want it to just be one, it's what the same. But the main reason why you see people actually open multiple is for the ease of taking partials. Do you understand? When you have trades running, it is easier to just swipe one or two and close than for you to go and be editing and modifying to what close. That is why you see people open multiple positions instead of what just doing one very big lot size and resting. Do you understand? That's why you see people like stack these positions in multiple ways, so that all they have to do when taking partials is just like close one or two and leave the rest running to avoid. All right, both of them are different approaches that you can use. For me, I think if most of you monitor my trades on Twitter very well, although I'm not active on Twitter for now until this some thing is over. All right, but if you trades as at like last year, early this year as well, you realize that sometimes I do what multiple stacking, and other times I just choose what just to open one or two positions and just leave it like that. So it's not like there's a, it's just that having multiple positions running makes it easier to close positions instead of going to modify and the rest of it. But it's the same as what you're going to get. All right, the same apple the other. Okay, now back to what I was saying. Now, when you've opened your first starting point, which can be as many positions as you want, but at the end of the day, you want to make sure that what the running margin is what exactly what you want. 40% to 50% of your entire risk should be open at what your entry. I already explained why, because your entry is what the cheapest that you're going to find price. So you want to make sure that most of is happening what at this level. Now the second thing, now after you've started at entry, if you've started at your entry and then price is already what selling down, one thing you need to understand, selling down, you are already in profit. All right, you're already in profit, most likely good profits. So the entire point of stacking is that you are now using your profits to open. And that is why most of you would see people post positions. Let's say they have a $10 account, and then what happens? So they have a $10 account, and then in place that says balance, you see what's -2. Meanwhile, their margin, they have like $50 running there. Their balance is negative, but their margin was they have like $50. This is because the money that they had initially on that account has been taken, but then they have profits still running. Do you understand? So the profit is acting like your capital. That is why that is even the entire point of start. Open more positions with your running profits. More like if you have a $20 account, right? If you have a $20 account, you've entered the trade now with $20, and then the trade has moved like this that the trade has made. All right. Let's say this is the, oh my God, I really hope that you guys understand what I'm saying. Let me just take it gently. All right. So here's what I'm trying to explain. Let's say you have account. All right. This is your account balance, $20. And then this is the entire move you are anticipating that price does. Let me use a buy to instead. Now this is the price does. This is your risk to reward. This is a trade. By the way, I just remembered now. I didn't show you guys how to get your RR. I explained risk to reward ratio in our last in classes ago, but I didn't show you. Now when you're done making your analysis, and then you pick up your buy to wherever you place from your stop loss to your take profit target there, you see this place that says open P&L -64779 QTY 33, that's quantity 33. If you look just below it, you will see risk stroke reward ratio 5.44, which means that this particular RR is ratio 5.44, which means that if you risk 100% on this trade, $100 on this trade, at take profit, you'll be making what? $544. All right, this is a 1:5, which means if you're risking one, you'll get, all right, you can see that in any way that I place my targets, the risk to reward changes. For now, it is what? 1:3.03. For now, it is what? 1:1.72. For now, it is 1.33. So this is how you get your risk to reward ratio. After getting your setup, all you have to do is to what, click on that, and then you get your RR. So now you can see the sell position now. This is for the sell position. You have your what, your risk to reward ratio 1:4.51. Okay, here you have 1:4 point. Let's say 4 point. Okay, 1:5 at this point. 1:4.99. All right. So whatever 4.99 times of that. Okay, that's how you get to your money that you see the risk to reward ratio there. For this one, I do. So back to what I was explaining on stacking. Yeah, balance. And let's say I take profit target now of this 20 move that you are anticipating towards this point. But then you have only $20 already placed the trade. Now at the point at which price is moving, at which price mitigates this entry. But let's say it has gotten to this level, you would agree with me that you've money already, all right, at the level that price mitigates and moving to it already. So the whole idea of your $20 plus the profit you've made already, you're using that more positions. Do you understand? That is why people start open more positions. Like a $10 account, you have what, a margin running of like in a $20 balance account with your, all right. That's the entire idea of stacking, to be able to open you can initially afford, because now you have what, you have profits running. So in this case now you have what, first stacking your end positions you want to open at entry, and then here comes the second stacking point, which is what, the first engulfing candlestick, which is found in the premium for sales and the discount for buys. Now, how specific points? When price creates this engulfing, you want to see the engulfing close before you buy. But this is strictly for when the closing of these candles to each other. Do you understand? Like you can see that here now, the difference between the point at which this candles, the bearish candlestick closed below the bullish one was what, was very, very close. This is the close. This is where the bearish candlestick closed. So as at this point, you can easily enter your positions at this level, right? You can easily just open your positions at this level. That's just stacking positions at this level, all right, but still maintaining the number of percentages, and then it won't be wrong. But you can't do that in a case like this, whereby this is the bullish candlestick and this is the bearish candlestick, all right, and then you want to watch close off. You can see that this close is very different from what happened at this close. This is the close of this one now, so you cannot be stacking at the close of this particular candlestick. So if you're stacking, it has to be at the close of what, but only on the condition that the two candlesticks close at similar points or very close points. All right. Now, in cases whereby it does not close at points, like something just like this, it happens sometimes. Trust me. For prices that are very volatile, you just see what, a sweep, like a very sharp engulfing form like that. So there are many times whereby you can have engulfings that are just like very sharp. All right. You don't want to be stacking at the close. Instead, you're going to wait for a pullback, like a mitigation of that engulfing. More like when you have something just like this, you're going for price to create this for you, all right, for price to pull back into that engulfing. So you're going to be stacking at the mitigation of the engulfing. Very different from when the close at, you're going to be what, stacking at the close. All right, now you can see that the second stacking point, or sorry, the third stacking point that was formed on this particular trade, which is what, this engulfing candlestick here now, where we have this covering what, this bullish one. They close at similar levels. This was where this one closed. This was where this one closed. All right, they close at similar levels, which means that you can what, stack at the close of the candlesticks. All right, for something just 3 stacking points before price what eventually left the 50% of this of this particular trade. Now you can see that even when price left 50%, it did what? It continuously created meetings, but then which is what? This engulfing, this engulfing. But I told you that strictly whatever you're doing must be what in the first 50%. You can see that this particular trade now, you didn't have any issues, right? The only thing that happened was probably this particular starting point now pulled back to mitigate this one before selling. But there was no retracement to map out to wipe out all of the trades that you stacked at these levels. All right. We can see that immediately price pulled into in a sell position, you started having what retracements. That is why I asked you not to stack at what discount levels, because you can see what there are now demand zones that can what temporarily affect price. Price a reason to do what? To misbehave for a while. So you want to make sure that whatever you're doing, you're stacking what in the first 50% for buys and in the first 50% for what? For sales, depending on this. All right. Now looking back at this candlestick that I drew, yeah, let me see if I still have that. All right. Now here's what I'm saying. If you're going to be stacking, all right, price has created an engulfing in your first 50%, and now you want to open positions. My point is that at the close of the bullish candle, this is where you go to your MT5 now and start opening the positions. But then when the difference between the two candlesticks is what's very significant, just like this one now closed and where this one closed. My point is that when something like that, when that is the engulfing that is formed in your first 50%, all you have to do is to just map it out like it's an order block, just like this. Just map it out like it's an order block, just like this, and then allow price to what? Pull back to it to mitigate it. So this is now the point at which you stack, the point at which price comes back into that can get it. Do you understand? It's very different from this one that when it closes, you just what? You just buy. This is how two of them are traded. If they have a very great big difference in what's in their close, and mitigation. But if it closes at very similar levels, you just what? You just trade the continuation, just like this. All right. These are the two ways that the engulfings can come. And then even when it's an inverse, like it is in whereby you have something just like this. All right, whereby there is a minute, please. Say in cases whereby we have something just like this, whereby there it's a bearish engulfing candlestick. All right, if stick and the bullish, if the bearish candlestick and the bullish candlestick closes at very similar level, what do? You just open your positions after the close and ride what's the continuation down like this. But then if they different levels, like what happened here, you're going to be waiting for what? A pullback into the engulfing before what you open positions at that starting point. Do you understand? They are very what? They are very, very different. Just like right? So let's look at what I have on my chart. Okay. So in this particular case now, sorry, let me back my scale back. All right. So let's look at this particular chain of trades here now. This was confirmation upon confirmation, pattern confirmation. All right. So at this point, we had price coming in an uptrend by the and price did what? Swept liquidity and broke a higher low. And you know what happens when price takes out a protected low? Once price takes out a protected low, then we have but that change of character is an unconfirmed change in trend until we have what? Until we have that change of character create what? Another higher high and another higher high and higher low. Lower high and lower low in this an uptrend, all right? And then we had price do something like that here and then something like that here. All right. So we had price formally and officially what? Confirm the change of character. Now after the confirmation of the change of character, if you look at what happened 30 minutes time of this pair, there was what? A sweep. And then that sweep went ahead to do what? To create this particular pullback before what eventually that low. So this is more like our type B market structure. All right, this is like our type B market situation when the inducement is created before price breaks to the downside. Now, if you look at what happened at this point now, price went ahead to do what? Now come back into that entry, mitigate the entry, and does what? Start selling. Now, set up for now. All right, let me take this. Sorry. Okay, yeah. So let's focus on this first setup for now. Now, price mitigates the entry and then gives you what? The first confirmation candlestick, which is what the hammer candlestick. I told you that when you see, sorry, the pin back candlestick, I told you back candlestick on your selling position, it's what the confirmation that price is ready to do what? Continue to the downside. Now that becomes what your first starting point, the positions that you want to. But then after that, you start looking out for what? For engulfing candlesticks. Okay, you start looking out for what? For engulfing candlesticks. Now, in a case like this, now this is was created here after price mitigated that entry. It went ahead to do what? Create this particular engulfing candlestick, which is what this bearish engulfing candlestick. Now, at this level, you can open one to immediately after the close. Why? Because the close of the candlestick is what? Very similar. Do you understand? The close of the candlestick is what? Very similar. Let me expand my screen so that you see. All right. The close levels are what? Very similar. But if you look at something just like this one now, this is a bearish candlestick, and this is what? This is a bullish candlestick, sorry. Bearish candlestick, which is our third stacking point now on this particular trade. But if you look at what happened, this candlestick, the close level and the close level of this candlestick very different. Do you understand? So for something like just like this now, you know what? You're not trading it at the close. Instead, you're anticipating that price pulls back into what? Into before you what? You take your trade setup. Something just like this. Now, you're anticipating that price pulls back what? Into the order block. In this case, now this particular stacking level missed. All right. But this to be traded, you need to see price come back into that particular point. Since the difference in where the engulfing levels closed was what was too significant. This is how you when price pulls back into what that level, that is how we're supposed to what stack. And then that stacking point missed. But what happened? Price what came down now at this level. Now you had what after the engulfings were for selling massively, and then it pulled back to create what another stacking level. Now, if you look at this stacking level, we had what a bullish candlestick and what a bearish candlestick. Bullish candlestick. Now you can see that the difference in their closure was what quite significant. Now, if you're going to be trading something just like this, you need to see what you need to see price pull back into what that particular. All right, which means that you're not just stacking at the close of the candlestick. Instead, you are stacking at what when price comes back into that level. All right, and you can see what happened here. That price came, mitigated the. This was supposed to be our 1, 2, 3. This was like the fourth stacking point in this level now. All right, after the pin bar, the first, the second, although the second one, which is this particular engulfing, missed. All right, but you can see that the fourth one that was formed there now, price pulled back into the engulfing candlestick and did what? Sold. All right, you can see stacking points at the same time now, and then price was mitigated and did what? Hit take profit target, just like that. So this is how you're stacking at the levels that the engulfing difference is what's clear. Levels whereby what they close at what similar prices. When they close at similar prices, you can just what write the continuation. But when the difference between the closure of the both of them is very significant, you await before what you open multiple positions at that level. All right, and then continuing, you can see that when price now mitigated this particular point now, what happened? It gave us what a type of pattern confirmation. Here you have what a level that swept this high. You had what this this then a break of structure, more like it was like a type A, by the way. because price came back to see what put in the structural point. All right, but then this particular valid order block it failed. Okay, it failed. Price took it out, and I told you that when the valid order block, just like this one now that met like most of your criteria for pattern confirmation, when it's being taken out, what happens? You're going to reclamation of that block, and that reclamation can be without what? Without an inducement. But if a let me say an invalid order block and you want to take a reclamation on that zone, you need to see what a structural liquidity being formed before price goes for the reclamation block. But in a case whereby it's a valid order block that forms it, then you can take it what without structural liquidity. And that was what happened there. Price took out this particular high with a very little reaction or even no reaction to this particular order before the taking out. Now, when something like that happens, what happens now? The particular point of interest, the initial point of interest becomes what? Your entry. And that is what happened and then came back. So what happens? You're anticipating that price pulls back into the reclaimed block and what sell. Now, price comes to the reclaimed block. What is the first thing you notice? Now, it did not form structural liquidity because it was formed by what? A valid order block. Now, when price comes to the reclaimed block, you can see that it gave us what? Our hammer candlestick rejection. If you have a trade setup that does not give you any of our 5 candlestick confirmations, just leave it. Leave it to go. All right? The proof that they are sellers selling at that point is the rejection that happens, or the proof that they are buyers buying at that point is the rejection that happens when market pulls back into that buying level. Do you understand? So you need to see any of our confirmation candles, your MT5 to click sell or what to click buy. Now in this case now, this is now a pin bar on the reclaim block. All right. And I told you that when this particular candle like this, you go what you take your 50% Fibonacci from the stop loss level, which in this case now is above the high of the reclaim block, just like this. The take profits level. All right, targeting this week low now, just like this. Okay, so all of your stacking is going to be done what in percent of this price leg. So let's look at this now. Now price mitigates the entry on the 30 minutes time frame and actually runs all the way down without creating any stacking points. So the entry was like the first stacking point, so you open like 50% of your positions or maybe 40%, depending on how many stacking points that particular pair usually presents. Right now, and then price runs all the way down without giving you what? Stacking opportunities. But then you notice that there is a pullback. I told you that when price enters discount now, you start having demand zones pushing it wherever. And there is a pullback of price into this discount level. All right. And that pullback takes you back into the discount. So now you're looking out for what? Opportunities to restack again this time around. So expanding my chart now, this was the first engulfing candlestick that was formed, which is what this particular one now. This now becomes what your second stacking point after. All right. And for this one now, you can see that the difference between this and this is quite obvious. Maybe on the 30 minutes time, on the 1 hour time frame now, the difference will not be that much. All right. But then on the 30 minutes, obvious. All right. So for something like this now, you can just wait for what the mitigation, which was what happened there when price pulled back with this particular candlestick now to mitigate what that level. Maybe that's where you'd have what entered your stacking. But significance, what happens? You stack what at the close, just like this, down. All right. But if it's very significant, you wait for price to pull back into that level before stacking. All right. So one stacking point after your entry, and then what happens after that point? What happened now? Price created what another stacking level, which is what this one here, this bearish candle covering what this bullish candle, which becomes what you, all right, or your third stacking point. Let me see. Okay, I think this is expanded now. All right, this stacking point, Okay, this is your first starting point here now, entry. Your second starting point, your third starting point, this particular what engulfing, they close at very similar levels. So immediately price closes, you just what? You just start selling for what mitigations. You just start selling because they close at what similar levels, and then price eventually broke out into the discount. All right, so there were no more starting levels after the three. Okay, after that price was broke into the discount. So at this level, you would have opened what the number of positions, many positions that you would have wanted to what open, and then price did what went straight to this week low and put in what another low target hit. And then watching out for what price will do now at this point. If you look at what happened, the price mitigated the entry. There was a sweep. There was a sweep of market structure. There was a break of market structure, and then there was a pullback that is serving as what our structural liquidity at this level now. And then before price eventually broke, typical type A setup. All right, it's like our typical type A setup. Now playing what happened now, that type A setup now. If you map it out to come again as like a pattern confirmation. I told you that on synthetics, you kind of see this order flow happen. That's why I added the type C market, the type C entry model there, right? You tend to see this order flow happen. It's like this now. Even I think there was the 10S and the 10 two, whereby demand zones create demand zones create demand zones create demand during that until change of character finally happened. So for something like this now, this is like another pattern confirmation on zone now. Now, if you look at what happened, price now like seeing what the hammer candlestick told you that the first thing that you do when you have a setup just like this is to people naturally to from what from the profit targets just like this that you would do must be what must be in the first 50%. All right, so which means that any starting that will be done at this level should be what inside of the at the expanding this chart was moving zoom 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 zoom. All right, but then let's take it very price mitigated the entry, gave you hammer candlestick, which becomes what when it closes below your starting point, you go to your MT5 and then you what open want to open. Now this hammer candlestick after price created price selling, selling, and then eventually we had like a sort of retracement. All right. Now this the bearish engulfing candles. This would have information on the 15 minutes, but then let's continue with what we have business with and what we'll trade. All right. Now this bearish engulfing candlestick can be more opportunity, like second stacking point. Price now eventually what broke out like particular point was mitigated or this particular stacking point at the entry. So I wouldn't want to because if it was created like below the entry, it's different. But which is entering at your first starting point and entering at this starting point is price now what mitigates that point and what start selling, start selling, start selling. All right, just like these sales happen, you can see that without is sold right into the discount. And I already told you that when something all right, the next thing that comes to your mind is what stops more position. Every of the stacking that you will do must be what in the if you look at what happened now when price pulled back into the didn't create the stacking level here, all right, but then it did high to the discount. But then when it came our third stacking point or our second now if you look at this particular stacking levels now, which is I showed you, but then if you look at what happened, difference between the point at which this closed and the is significant. All right, it is at close at 712 at what 706 or 700 All right. So when something like this happens, I told you that you out from this point towards to this point, and you're going to be starting at the level. All right. So you can see that when after this clue to the point at which what stacking. All right. This becomes your what your third, and this is where you now open more positions. All right. And after what and this bullish candlestick and what this bearish. So what happened? This bullish candlestick and this bearish candlestick, they close at. So you're not mapping out anything just like you mapped out for the first one. You're not right. It's continuation. Immediately price you go to your MT5 and what open more positions. Not stacked enough yet. Open what more positions to write down. You can see the different approaches. If the difference is what's very obvious, what are you going to do? You're going to wait for price to pull back into before you stack. But if the difference is what's as little as this, you're waiting for price to act do what just like this. All right, that is the difference between stack engulfings that close differently, like in a very sick or what very similar price. So it's already 10 o'clock, but then I've not treated where to set your stop loss while stacking. At the it will be something that you guys are comfortable with without those people like me that have having issues with. All right. So I'm just going to stop. If any questions, as usual, I the question group. If you think your question is unattended to, all you need to do is what state at any point. I want us to meet to the purpose of this something that I wanted to treat today that I what where to set your stop loss while stacking because you understand points. All right. You can see that this particular stacking point now. All right. You cannot be stacking here or stop loss. It's not right. All right. So there are different levels stacking positions at specific, and so different levels have what they are different to trade where to set your stop loss while stacking. It be a bit overwhelming, especially for the newbies that are just like coming. I want you to go over it and then no question, no matter how uncomfortable it sounds in your head, right? To make sure that you don't get too confused about this. Then it's going to be dropped on the group. If you go through it and you still have questions as well, join the people asking questions on it. All right, but then it's something that is catchable, something that you just go to you're going to get used to it, and then it becomes part. Recognize this thing. All right, so I want us to meet tomorrow, and I hope that is not going to affect most of your schedules. Please stop loss while starting. So there's class tomorrow by 9 p.m. Tomorrow Tuesday. Of ourselves until we meet then. Any questions? Just open the questions of tomorrow. But Stan, you can end the recording. Thank you.